Hi, welcome to Bond Bytes, the daily bond market highlights from INR bonds. I'm Arjun Patsarthi. And in a sudden move, the finance bill that was passed today, the government removed the tax arbitrage on debt mutual funds. And this has a highly positive impact on bond markets. The government removed the long-term capital gains tax that was available for investors in bond debt mutual funds for 3-year plus holding period, and they have made it as they have termed it as short-term capital gains. And now this will take off all kinds of tax arbitrage that was available on debt mutual funds. The AMFI data shows that there was 5 lakh, around 5 lakh crores of investments in debt mutual funds of over 24 months maturity, which is over 2 years maturity. And of that, 90% was invested by corporates and high net worth individuals. Now, and this a lot of it had gone into funds like target maturity funds. That was pure funds that were invested for a 3-year plus holding period to take advantage of the long-term capital gains tax benefit. And the retail investor participation was only 12.5%, just around 60,000 crores. Hence, the government decided that it's not really benefiting it's not really going down to the end retail investor to whom financial inclusion should take place. And it was basically seen as a tax arbitrage product for corporates and high HNIs. Hence, that removal, now it changes the whole scenario for debt markets, because when investors invest for a tax arbitrage, they hold it to maturity or for a 3-year plus period. And when they hold it for a 3-year plus period, there is not much of churning in the market in terms of portfolios. The bonds remain in the fund or in an investor's hands, if in the fund's hand, if it's a target maturity fund. And clearly, so with this removal, what happens is that corporates and HNIs will have to take decisions on what is the best investment available, and also continuously look to position their portfolios for movements in interest rates, movements in credit spreads, what's happening to the environment, etc. And all this, there could be more trading in the market, and that could increase volumes in the corporate bond market, which was lacking. Also, the government bond market could see more retail investors, largely because through the RBI retail direct platform, as government bond investments also come on par with all products. And hence, there could be a lot of move towards the retail the retail direct platform. However, the RBI has not yet clearly opened it to platforms, which makes it much easier for investors to understand and invest in the product. And once they do that, then they could see a lot more investments in government bond, both primary and secondary. Corporate bonds too will see a lot of retail interest and corporate interest. Once, because of the fact that private placement face value has come down to 1 lakh crores, rupees 1 lakh face value, and this could enable more diversification, and the comparison of products has become bond to a fund becomes much easier. The funds also will have to start looking at their expense ratio policies, because if a fund is yielding, say, 7.5%, but expense ratio is 0.3% or 0.5% or 1%, then, and if a bond is yielding 7.8% for the same maturity, the bond is definitely more attractive for investors if it's the ease of investing. A liquid PSU bond can be much better than a fund as well. So a lot of opportunities for the bond market now, especially with this tax arbitrage being removed. And this can really spurt the volumes in the bond market, increasing the depth of the market, enabling more issuers to come to the market, and all other aspects of that. when more direct participation happens in any market. In other market highlights, flat Gsec yields, 10-year and 5-year yields are flat at 7.3% and 7.16% respectively. Equities were down, INR was better, rupee was better, and PFC issues 10-year bonds at over 7.6% levels. As we go into the year end, markets are expected to quieten down. Just as a closing word, there could be a lot of investors who have already invested in 3-year plus products would continue to hold them to take advantage of the benefits available for tax as it's closed from 1st of April, further incremental investments from 1st of April. And here the investors and financial advisors will have to be very sure what the expense ratios are, because they would need to keep re-evaluating the expense ratios continuously if mutual funds tend to increase the expense ratios, because of the fact that investor money could be pretty much sticky if in these products, given the advantage that it offers, at least for the older investments. Thank you very much for listening in, and do not forget to log into INR Bonds Partners if you are a financial advisor to check the best bonds available for your investors to invest in. You can compare it with all other products in terms of risk and return, and just choose whichever bond is applicable to your investor risk profile, and with the most seamless investment process, along with complete support from INR Bonds, with information and all other aspects of investing in bonds, with the best price discovery process as well.
As a financial advisor, my biggest responsibility is to help my clients make the right investment choices. Now, with INR Bonds, buying and investing in bonds for my clients is quick and easy. With my guidance on bonds, my clients are happy and I'm getting new business every day. Register as a financial advisor on inrbonds.com to help your clients invest and save better through bonds.
And if you are looking for a curated list of bonds, download our app, Quick Invest by INR Bonds, for the best curated list of bonds on offer. The curation is done from well over 300 plus bonds that is being offered on our platform on a daily basis, based on our own proprietary risk score and other parameters, with most information and the easiest of in-app investment processes.
It was a tough journey going from an intern to a senior professional. Now, to protect my savings against high inflation and grow my wealth, I invest in bonds with INR Bonds. Download the INR Bonds app to save better.